Hi, I'm your host, Greg Weldon, and this is Money, Markets, and New Age Investing. We're season 3, episode 9. Been a while since I've done an episode, back to May 24th, I believe. And within that context, only because we almost had World War III breakout in June. So it was pretty much pinned to the screen 24/7 for news and quotes. And as you could probably tell, it was a pretty hectic month for sure. But the bottom line hasn't changed. The narratives that are important for 2025 remain the same narratives that have been important for 2025 since the year began. And that number one is the consumer. And this narrative around how the consumer is strong, the balance sheet is healthy, the labor market's strong. And it's funny because you get commentators on Fox who would suggest, well, if you take this payroll number and try and say it was soft, you're basically rooting against Donald Trump, rooting against the economy, and somehow unpatriotic. When those same people are having interviews where the guests are basically insulting Chairman Jay Powell with, he's an idiot, he's unpatriotic, and so on and so forth. And if you really just dug down and understood the dynamic behind all of this, you would really see that the labor market is key to this in terms of making a case for Powell to cut rates, all right, as opposed to being upset because you were suggesting the labor market is weakening. Guess what? The labor market is weakening. Get over yourself, and let's not say, okay, because the headline unemployment rate fell from 4.2 to 4.1, and the headline payroll gain was above 100,000, that the labor market remains AKA solid, AKA strong. It doesn't. And I can blow it all away with one simple point of order, one simple data point. That the largest change of any number in this entire BLS employment situation report for June was the number not in the labor force, which rose by 329,000. That is why the unemployment rate fell, because 329,000 people fell out of the equation. The employment number was up 93. The unemployment number was down 222, which is good, but it also reflects the fact that some of those people, over half of those that are no longer unemployed, are no longer unemployed because they dropped out of the equation. The participation rate fell too. Did anyone bother to notice that? Did anyone bother to notice that the number not in the labor force has now reached 2.88 million over the last 12 months? The rolling 12-month net change is 2.88 million. The only other times, only 3 times in history that it's been higher. Understanding the math, that you have a higher base because there's more people employed, so on and so forth. It still means what it means. 208.8 million. It's not chump change. It matters when the only other times it's been this high was 2009, 2013, and 2020, 2 of which were major crisis periods, at least to lead into. Now, out of the employment, only 74,000 was private. The rest was government jobs, which are falling. So throw that one out the window. And of the 74,000, two of the 19 industries for which we get a breakdown from the BLS, only 2 of 19 posted job growth that accounted for the entire gain. Health and social services, number 1. Leisure and hospitality, number 2. The second one being the second lowest paying jobs of all. Strong? That's not strong. It's especially not strong when 8 of 19 industries posted job losses. That we haven't seen more than 2 in any given month for many, many, many months. And now we got 8 out of 19, almost half, reporting job losses. Strong? The number of people receiving unemployment benefits, a different weekly report, 1.974, jumped much more than was expected, a 3-year high. It's up 130,000 in the last 9 weeks alone. And it's the highest since the pandemic. And it's the number of people receiving unemployment benefits is soaring. I mean, that's 60,000 a month. It gets worse because weekly earnings were down Deflation was here. 8 out of 19 industries reported job loss. That's deflation. All right. The fact that people dropped out and that's why the unemployment rate fell is deflation. Weekly earnings fell for the month. That's deflation. All right. And part of that is because there were less hours worked. So this is this myopic focus on average hourly earnings. It's meaningless. It's how much you take home at the end of the week based on how many hours you work. And when hours worked fall in 14 of those 19 industries, the other 5 were unchanged. Not a single industry out of the 19 industries for which the BLS gives us detailed data had an increase in hours worked. 14 out of 19 were down. Overall, the index of aggregate hours, often used by economists as a proxy for GDP growth, fell by 0.3, which is an annualized GDP proxy of minus 3.6%. That's recession numbers. Strong? Where's the strength here? I don't see anywhere where there's strength outside of healthcare hiring, to be honest with you, social services. Let's talk about wages broken down by the industries. 11 of 19 industries reported lower earnings. It's almost 60% of industries lower earnings, not unchanged, not subpar growth, lower. 58% of industries. The average earnings on a weekly basis, year over year, in the last 2 months, 4.13 in April, 3.81 in May, 3.41 in June. It's down 72 basis points in 2 months. That's 3 Fed interest rate cuts. Decline in labor market average weekly earnings in just 2 months. Real earnings, even worse. I mean, it's less than 1%. It's 0.7. 0.7, 3.41 versus 2.7 core CPE year over year. It's 0.71, down from 1.43. The real earnings just cut in half in the last 2 months, and they were already subpar at 1.4 year over year. Strong? Man, come on. Look at the numbers. That report was not strong. Neither was the New York Fed's household survey of consumers. Really interesting stuff. All right. The 1-year inflation expectation has fallen. It's 6.6, down to 3.2. 6.6 at its high. Now 3.2. It's cut by more than half. Still 3.2. And the median prediction point, same number, different measurement, is 4.3. 4.3. Not only that, but still the largest percentage of consumers in any category still put inflation above 4 in the next year, 42%. Overall, those expecting inflation below the Fed's target within a year, 34%. Expecting inflation above the Fed's target, 66%. Still heavily weighted towards higher expectations for higher inflation. 3.2 and 4.3, these are high numbers relative to a 2% target. All right? And especially when you compare it even to the 2.7 PCE core rate. All right? Now, here's what gets really interesting. And to those who say any of these numbers are strong, doesn't go all the way digging deep enough to see where the reality lies. And the reality lies, if you take that inflation expectation and compare it to the 1 year ahead labor portion of the survey, income expectation, earnings, again, income, wages, all right? In the last 2 months, it's fallen from expecting 3% year over year, or in the next 12 months, down to 2.5. Down to 2.5. It's the lowest in 4 years. And on a real basis, compared to the 1 year inflation expectation of 3.2, consumers just told the Fed, we expect our 1 year ahead real income to fall by 0.7, almost 1% decline. And at the I earn less than $50,000 a year income level, if you break it down by income distribution, the expectation for nominal earnings growth, 1.1, which against that 3.2 inflation is minus 2%. The lowest income levels just told the Fed they expect their real income to fall by over 2% in the next 12 months. Strong? Consumer? Healthy? I don't think so. Not according to the facts, not according to the numbers, not according to the data. Let's turn to PCE. And before I get there, I'm going to jump ahead and then roll back real quick. That in fact, while the year-over-year, 12-month total, increase in public borrowing remains huge, public debt, public borrowing, for the first quarter of 2025, it was down from the fourth quarter by $2 billion nominal. I mean, it's almost nothing. It's pennies on trillions of dollars in debt, but it was down quarter over quarter. We've only seen that once in the last 10 years, and that was in 2015. But that also has an impact on consumers and income as per government transfer payments, which make up a large part of personal consumption expenditures, income. Wages and salaries, to start off before we even get to the government handouts, wages and salaries rose only $49 billion. That's the second lowest in the year, and I'm telling you, below 50 is low. All right. And against that, proprietors' income dropped $49.4 billion. That's a huge and very rare decline. So all wages and salaries for all the workers offset by proprietors' income, which fell. Net, zero income growth, zero wages and salary growth, zero. Now, obviously, more people get wages and salaries, so that's an overstatement. But you understand my point. And the point goes even deeper, because personal income, excluding government transfer payments, and that means handouts, social services, and entitlements. Ex transfer payments, personal income was down $110.4 billion. $110 billion. I mean, on the monthly basis, down 0.4. All right, that's the first decline in 4 years, and it was expected to rise 0.3. Big miss by Wall Street on that one. Overall, disposable income down $125 billion. Savings dropped $97.5 billion. And you know what else fell? All this other time, you've been using savings or credit cards to boost that spending. But since they're not doing that anymore, as we're going to look at revolving credit in a contraction, a rarity since July of last year, spending fell. Spending fell by $45.4 billion in June. All right, on services it fell, and that's been really relatively, immune to some degree. Down $2.8 billion. Durable goods down $39 billion. Non-durables down $10 billion. And yet prices went up. PCE headline from 2.2 up to 2.3. For core rate, 2.6 up to 2.7. Wonder why the consumer's choking. Well, now he's either unwilling or unable to continue to borrow money on their credit cards. Consumer credit, Fed numbers, delayed a month, but consumer credit rose $5 billion in May. Was expected to rise 12.9. It rose by less than half. And let me tell you, 5 out of the last 7 months of below $10 billion a month, and $10 billion a month below is the warning sign. That's the yellow line. Okay. Above that, you're green. Below that, you're in the warning zone. Rare that you get into the red zone where you're actually negative. It's only about a warning zone. But here's the facts. July of 2024, consumer credit was $5.05 trillion. 11 months forward to now, $5.05 trillion. It's exactly the same. It hasn't moved. The year-over-year rate is 0.4, off the Feb low of minus 1.1, which, by the way, was lower than the pandemic low of minus 1% in spending. So the decline in spending into February was worse than during the pandemic. And yet people say the consumer's strong. April's consumer credit growth at the high of April 2022, when the Fed decided to finally pump the brakes, consumer credit was growing at 10.1% year over year. It's now 0.4 and is actually unchanged for the last 11 months. So that's kind of a real problem. It gets even worse. Revolving credit, and I don't take any pleasure in the gloom and doom. I don't, spiritually, energy-wise, life-wise, all positive. It's just the reality of the consumer and the economy, and where this is all going is unfortunately not uplifting. But it's the reality that people have to deal with, and if you'd rather, be an ostrich, stick your head in the sand and ignore it and do nothing, you will pay the price. Revolving credit, which is mostly credit cards. The Fed's number for consumer credit, they break it down into revolving and unrevolving, but revolving credit, minus 3.2% annualized for the month. Minus 3.2%. That's a deep contraction. That's really bad. It was up 3.1% in the first quarter, up 3.2% in the fourth quarter last year, up 3.2% in the third quarter last year. In the last 9 months, it's gone from 3.1, 3.2 steady to minus 3.2. The flow, rolling 12-month change, down $42 billion. A month ago, it was up 89. It's the first decline since 2020, and only the third in history. 2008, 2020, and now. The only 3 times revolving credit has been negative on a year-over-year basis. Come on. 2008, global financial crisis. 2020, global health pandemic. And now, what is now? It's a consumer cocoon and a consumer credit contraction. It's deflation. All right. Now, let's talk about public debt. All right. So when you kind of talk about this, you have public debt is down for the month. So this is a big negative. So this thing with PCE and transfer payments, this is going to intensify. Having said that, there is a bailout here, all right? And it comes from the fact that when you combine commercial bank balance sheets for loans and leases and the Fed's balance sheet, combine those two totals in terms of the rolling 12-month change. Okay, there's only one time in history where it was upside down, where, in other words, the total between the two was net negative. And that was October of 2009 through March of 2010, the only other time. And now, since December, let me check that. Where is my reference on this one? It was 2023, whichever month it was. So from that perspective, it's really kind of interesting to see this upside down. The Fed's balance sheet, minus 568, but bank balance sheets are big positive. And here's the positive in it. Okay, you're up 516. This is one of the highest non-pandemic changes in commercial bank loans and leases since 2016. You're talking the period of 2014 to 2016 and 2005 to 2008. And think about those periods and what they led to. We are at levels above $500 billion in a rolling 12-month basis in commercial bank loans outstanding. All right, is also the highest since March of 2019. So that's really positive. But it goes against the Fed's balance sheet, which is still QT. It's still negative, $568 billion. And here it is. It's been upside down. In other words, these two things combined, Fed balance sheet minus 568, bank balance sheet plus 516 means a negative net number. It's been negative since week of July 26th. These are weekly numbers of 2023. Almost 2 years this has been negative. Think about when this flips into positive. That's a big liquidity positive to whatever extent. And, riding kind of the fact that at least companies are still borrowing and banks are still lending. It's just not the consumer. It makes up the bulk of the economy. The other thing that's positive here, and we talk about positive in terms of, the attitude towards the Fed and how that's impacting the markets, particularly metals right now, with the big runs we've seen in the last week, is money supply. M2 at $21.9 trillion, back to a record high. All right. It's up 83% in the last 10 years by $9.9 trillion. All right. But it is running kind of in hyperdrive with a $941 billion rolling 12-month change. That's only the fourth highest ever, excluding the pandemic. October 2016, April 2012, January 2009. The only other times when the 12-month running change in M2 money supply was almost $1 trillion right now. So these are positives that are in a backdrop. And it comes down to the Fed. Because when the Fed goes back to at least unwinds QT, they're no longer doing QE, it's QT, and they will be doing QE. They're going to have to because they're behind the curve again. You got people going on Fox calling Powell an idiot and unpatriotic. No, how about we take Jerome Powell's own change to the entire Fed approach. The new policy paradigm under Jerome Powell, introduced in 2018 through 11 different white papers, over 300 pages. I read every single word. They laid out how they were going to lift inflation, get it above average, above target, and then bring it back down. And they did exactly what they were going to say. Inflation above target. And they had all kinds of formulas and academics and, equations and everything, deciding on whether to use what moving average, how long, use a weighted one, how to weight it. Okay. Do you use tolerance bands or not? In other words, we'll let inflation get above target, but if it gets to 6, we'll start to move. No tolerance bands, meaning complete tolerance for any rate that it gets to. And then use the quote-unquote Volcker playbook to bring it back down. And this is all because, of course, Powell is a Volcker disciple. All right. The dynamic around these two, I did a piece last year comparing 1978, Paul Volcker's first Humphrey Hawkins testimony to last year's Jerome Powell Humphrey Hawkins testimony, and the verbiage, the syntax, the words was almost the same. The biggest differential was glaring. Volcker, with almost no debt back in 78, was careful to say we don't want a credit contraction for the consumer. Both Powell and Yellen have said that wouldn't be the worst thing. And guess what? That's the genie you don't want to let out of the bottle, is the debt deflation genie. Because of credit contraction, when you are now relying on credit to grow the economy to service the debt, you're in that death spiral, you're in that black hole. You can't do that. All right? You will choose to reflate every time. All right, so Fed's behind the curve for the third time in the Powell Fed. I like Jerome Powell, and I don't think you have to criticize him. All you got to do is use his own new policy paradigm as the evidence as to why rates should be lower already. All right, 4.25 is the low end of the range. The effective Fed funds rate right now is 4.33, 4.5 basis points below the midpoint, which tells you something. The pressure is on. There's kind of ample liquidity, so to speak. When you look at the inflation rate, the PCE core rate at 2.7, you want to say you're waiting for tariffs. That's all well and good. All right, we don't know the impact of tariffs, and copper just showed us what it could be. I mean, platinum's up 40% in like 3 weeks. All right, but when you talk about where the real Fed funds rate is right now, it is 164. All right, in 11 white papers, 300 plus pages, I read every word of the new policy paradigm. They defined R star, the natural rate of a neutral policy. Just for all different countries, fascinating research. 50 basis points above inflation is U.S. R star. Let's say we double it because of the pandemic and we get interested here in, playing fair. Let's say it's doubled since R star. And let's say, because, this was 2018. Let's say, and you're coming off, 0 and negative rates in Europe. So let's say the reality is that the pandemic has jacked rates enough, and you do have the 40-year trend violation of interest rates and inflation to the downside and the new uptrend. So let's just double R star and make it 100 basis points. That would still imply that you should have cut rates twice more already. That rates should, at a minimum, be 3.75. And if you use the 50 basis point R star, rate should be 3.25. This is Powell's own policy paradigm. Then you should be neutral, meaning you should be at worst at 375, at worst 2 cuts, cut 50 like immediately. And I'm not saying they're going to do that. I'm not saying they should do that. I'm saying if you want that to be the outcome, here's the tools. All the consumer data I just gave you, still 70% of the economy. And you need to be at least neutral. You don't need to be restrictive here. Not with a consumer cocoon, not with a credit crunch, not with a housing market depression for all intents and purposes, even though prices are not reflecting that, which is even worse. And a labor market is now experiencing whiffs of deflation. Powell's behind the curve for the third time, both up and down. Transitory, you remember that phrase and how much we bashed that? It was like waiting for Godot. All right, they're going to have to play catch up to other central banks that have already moved. The ECB way ahead of the curve, Bank of Canada. You have RBA and BOE a little bit, in between the Fed and those other central banks, and the BOJ and PBOC are actually in an easy mode. It all comes down to the dollar. It's all about the dollar. And that's what's changed in the metals. That's why silver all of a sudden has gained a lot back on its ratio spread against gold that everyone was complaining about. How can it be 100? How can it be 100? How can it be 100? It can be 100 when central banks buy hundreds of tons of gold and no silver over a 2-year period. That's how. All right. So to see, and I said repeatedly on the podcast to my clients in person, wait till the dollar breaks. It will break. And when it does, silver will go too. And that's where we're at now. This entire dollar thing goes all the way back to the Carter administration, defeating inflation. Paul Volcker, 1979, 1981. All right. The Volcker rate peak in the dollar, right, was very strong. Into 1985, where the group of 7 got together and came out the Plaza Accord, New York City. I remember getting on the train that day to go down to the commodities exchange where I was working at the time in the gold and silver pits. And I heard on the Quotrex, you had there was no technology back then. No email, no computers, no quotes at home, just a Quotrex. That the Plaza Accord had been signed and all hell broke loose. Big dollar down. All right, dollar all the way down until the double bottom set in 2008, 2011. Double crisis period. Don't forget, 2011, first U.S. debt ceiling crisis. Stupidest phrase ever. Debt ceiling, that's an oxymoron if ever. There's no ceiling on the debt. We know that. All right, never has been. But 2011 was also the EU sovereign debt crisis, which was a big deal. That was a double bottom in the dollar. And the dollar has rallied for 11 years since then. ABC, perfect pattern. Fibonacci to the nth degree, 38, then 50% into the 2022 high. The entire 26-year bear market was corrected in 11 years. All the ratios are just laid out so perfectly. Now the dollar is, you're pushing people away from the dollar on trade. BRICS unit's going to be a reality at some point in time. All these things are for real. Foreigners selling central bank assets. Selling rather U.S. securities. The dynamic is the public owns most of the debt. The rest of it's owned by commercial banks and the Fed. So, we're the ones that are going to pay the price. And that's in a lower dollar. All right. The dollar violates the 2023 low, which was important. And then the swing back to the upside this January was a perfect 61% of that move. And all of a sudden you're below the 5-year moving average and you're down 12.5% from the 2023 peak. You were running almost 9% on a rolling 12-month basis at one point just 2 weeks ago. So this is why silver has exploded. And frankly, if you look at silver, on a monthly close-only basis, it is set right now, where it is now, assuming it holds through July, which is a big assumption these days, and I'm not willing to assume anything anymore. But that would be a retracement, that would be the third highest monthly close-only ever, behind only August of 2011 and April of 2011, even higher than the January of 1980 high, which on a monthly close basis was 35.75. Not only that, to get the gold-silver ratio back to kind of where it was on average, say, for the last 10 years, you're looking at $47 silver. And what is the high set in April of 2011? $47.85. That's where you're going. Just straight up. And, this move has still got a lot of legs. And frankly, if you then want to, again, that just reassesses you compared to gold at a minimum. How about platinum? We recommended platinum. The PPLT was the ETF. It's at this highest level since July of 2014. It's a 47% since we first talked about it. All right. You're talking about the third year of supply deficit heading into a fourth year where by the end of next year, supplies could be less than 3 months of consumption, above ground supplies of platinum. Palladium finally followed. I said it would. It was $990 when we said it was going to follow platinum. It's $1263 now, up 36%. You can still get involved. Silver is still early, I think. SLV is the silver ETF. I prefer some of the equities now. The PPLT, the platinum ETF, PALL. I also mentioned Sibanye Stillwater. It said below $5 it was value. It's now pushing $9. All right, the SIL, still very valid. $94 was the 2011 high. It's last at $50. So it's got a lot of potential upside. But a less expensive way would be the SILJ, which I personally own, 1581, broke out at 1518. It's not that far from the breakout. And 2012 high didn't exist in 2011. It was almost $22. All right. I like First Majestic. I've talked about it before. I own it. All right. It broke out at 750. It's now 9.25. MAG, which was my favorite, taken over by Pan American, and it's trading above the offer price. So I don't know what's going to happen there. It could be interesting. We liked Heckler last year. I don't like it here. It's too hugely owned. It's underperforming. It's a little too volatile on an interweek basis. I much prefer now SVM Silvercorp in Canada. 2020 high was $11. It's still only $7. In 2011, it was almost 16. And really, right now, if I had to choose one to buy now versus First Majestic would have been maybe a month or two ago, it's Endeavor, also in Canada. Breaks out at 566, but it's still only 584 with a $13 high in 2011. So that's just some picks. We do this every day, so there's always a lot more going on in all the other sectors too. We cover all the sectors, every industry, every country. Copper is the other one to note. 568 last. That's a record high. It's up 41% just from where it was in April, where it was only $4. Now, this is because you've seen a huge declines in inventories for two reasons. Number one, U.S. Manufacturers imported a lot of copper when tariffs were first talked about. So the tariffs are bad, and 50% is bad, and it does threaten longer-term dynamics. But in the short term, it's not going to affect the U.S. as much as it will actually China, because Chinese inventories of copper have fallen by 66% since September of last year. Check that. That's LME. I'm sorry. LME, 66%. China's stock's down 20% since March, down to 130,000 tons in Shanghai, 108,000 tons in the LME. And it's about 400 in total. So you can see half of it's held in the U.S. now. All right. But overall, inventories are down over 25% just since the fourth quarter. So that's a big for copper. I also like crypto, and I did a special piece on this, and we actually talked about Bitcoin in the last episode of Money Markets and New Age Investing. All right. Bitcoin, the breakout targets on a measured move alone, a minimum upside of 169,500. All right. We bought Ethereum for the money management clients at 28.91 when it took that level out. You're now looking at 41.40 and then 4,900. All right. Bitcoin against the S&P is up 9.6% over the last 12 months. And that's just bouncing off a low. So that's low. So you're buying it at a very cheap level compared to the stock market relative to past outperformances we've seen from Bitcoin against the S&P 500. Interesting way to look at it. Ripple. I bought it at 238 myself, actually, this past week. 265 was the breakout. This entire decline from the 2025 high has been a perfect fifth ABC 50 and then 61% retracement. You violated the downtrend line. It's up 16% since I bought it, or, like in 2 days from earlier in the week. And I could, 329, 339 probably has $4 in it. And the other one I'll mention at the risk of, I'm not an expert on AI. Having said that, I remember reading the Bitcoin paper way back, like literally probably 2011 when I finally read it. It was already 2 years old, but many people had not read it by then. Reading the paper from Bitensor and Tau, T-A-O, Tau is the crypto. It's an AI protocol, much like Bitcoin wanted to be a kind of decentralized currency, quote unquote, protocol. So it's kind of interesting how this plays in, and I read the white paper. It's very interesting. And again, while I don't know a lot about AI, having done this since the time before there was cell phones and email and computers and all of this, when it was paper strewn all over the place, I've seen all these changes. And I think that when I see kind of where I think AI is going, and I read the paper from Bitensor, it makes sense to me. It's really that simple. Tau breaks out above 402.65. It's been crappy. It's been bad performance. All right, you have a 2-year downtrend. But that's where the downtrend line is, the 200-day moving average, and the breakout really to a new high would be 488. But it's been like 750. So we'll see. Just keep an eye on it. I think it's an interesting thing to watch for fun, as it were. And for disclosure's sake, yes, I do own First Majestic, Ripple, New Gold, by the way, SILJ and SIL. All right. In my fund, we own silver, gold, platinum, copper, palladium, gasoline, soybean oil, and Bitcoin and Ripple. Bitcoin and Ethereum. So just for disclosure's sake, now you can follow me at Weldon Live on Twitter. You can follow the podcast on Twitter at money_podcast. Follow me on YouTube at user_Gregory T. Weldon on YouTube. Again, from the perspective of owning a lot of the metals and having, really done well over the first half of the year, this is something that we set our money management account and money management program up specifically. I'm a math and science geek. I wrote algorithms way back in the 1980s. We've licensed them out to institutions. We could be an ETF. I could have created many ETFs off of that. But in the context of the discretionary trading, which now 40 years of experience has really honed me to where I really feel, I see the risk reward better than I've ever seen it. It's been nothing short of outstanding. So if you want any information about that, accredited investors only. I won't talk too publicly about the performance, but let me tell you, it's outperforming performance. You can email me at Greg Weldon, GREGWELDON, at weldononline.com. And thanks. Hey, thanks a lot for listening. I appreciate you all out there.